everybody can invest in the S&P 500, but doesn't it make you nervous sometimes, the volatility? I've invited a guest today that will explain to us how we can generate similar returns with a lot of less hassle. His name is Steve Bavaria. He's the author of The Income Factory, and I'm really looking forward to a discussion with him because who doesn't want to invest stress-free? Let's see how we can achieve this in a time where there's so much uncertainty. So, welcome to Soar Financially, where we discuss the macro to understand the micro. My name is Kai Hoffman, and I'm your host of this channel. I'm really looking forward to this discussion. But before I switch over to my guest, hit that like and subscribe button. Helps us out tremendously. And if you haven't noticed, we're back in the studio. We've been on the road for 6 weeks. We are back, and we've got lots planned for this fall. So hit that subscribe button. You won't regret it. So thanks so much for doing that. Now, Steve, it is great to have you on the program. Thank you so much for joining us.
Thank you, Kai, for inviting me. It's a pleasure to be here.
Yeah, really looking forward to this. Looking forward to learning a new investment angle and a different approach to investing. Stephen, before we get started and talk about macroeconomic situation in general, run us a bit through the Income Factory. What is it? And run us through it. How can we duplicate it?
Well, the Income Factory is a kind of clever name I came up with for my book that I wrote about 5 years ago. But it was a way of investing that I evolved over time it's really classic income investing of the sort institutional investors like insurance companies and pension funds and other big entities like that have been doing for generations. And I learned about it as a banker many, many years ago. And then I became a journalist. And as I retired and started investing my own money, mostly in an IRA, I found that it was tough. It was very stressful, as you said, to try to do classic indexing or dividend growth investing, because when you're investing in growth stocks or even just normal S&P 500 type equities, you're basically expecting a yield of about 1.5%, because that's what the S&P 500 pays. And if you want to make your 9 or 10% average equity return, which has been the equity return over the last century, basically, you're really betting on getting an additional 7 or 8% capital gain on average every year, in addition to your 1.5% or so dividend. And, you don't get that every year. So you have these ups and downs, and it's tough to sit through the downs while you're waiting for the ups to come again. And not everyone has the, true grit sort of patience to do that. And I had a lot of trouble, especially, you hit the great recession of 18 years ago or so, and then the more recent COVID thing. It's so easy to lose your nerve and say, hey, I'm going to move to the sidelines and wait till things get better. And of course, if you do that, often experts will say you miss the train when it leaves the station. There's no conductor saying, hey, the market's about to go up again, get back on the train. So I found investing in credit and high yielding types of, mostly credit, also some utilities and equities that pay extra high yields, where you're not depending much, if at all, on growth, but you're getting your entire 8, 9, 10% or so. Lately, it's been a little more in yield. And if you can get that, if you're younger and saving for retirement, you just reinvest and compound at that rate, you will do just as well, even though the conventional market, and I've written about this, and I got treated like a heretic when I proposed this 10 or 12 years ago and started doing it and wrote about it on Seeking Alpha. But you double and redouble your money if you're reinvesting it at 9, 10% every 8 to 9 years. You do that for 30 years, 40 years, you're going to do just as well as if you did an index fund, and made your 10, 12% average on equities, because some years you'd have a -5, other years you'd have a +3, others you'd have a +12, et cetera, et cetera. But math is math, and it comes out the same. So that's my basic shtick, my philosophy. And I do it. It's not without stress. I mean, you still have, even in the credit markets, you can be invested in a portfolio of senior loans. They're funds that I invest in, senior loans and high yield bonds and other corporate credit instruments, where you know it's very predictable what you're going to get. You can even predict levels of default that are statistically demonstrated, that are statistically calculated over the last 40 years. So we know what defaults are going to be in normal years and recession years and super bad recession years. But even when you crank all that in, you pretty much know what you're gonna get over time, which you don't know in an equity portfolio. And it just does make it easier to sleep at night, even during periods like this. And that's what we'll get into. It's not without stress, but there's always stress, unless you want to put your money in in government bonds and things like that. But if you want to make an equity type return, there's going to be stress. It's what sort of stress? And I find credit risk and that sort of thing is a lot easier to project and live with than the volatility of the equity markets.
Yeah, absolutely. And nothing is stress-free if you invest in public markets. I might have exaggerated a little bit in my opening here, Stephen. But when you ran through sort of the asset classes and things you're investing in, like besides utilities, like how recession-proof is the investing strategy here, Stephen? How can we sort of put that into a framework that we're currently entering?
Pardon. I'm a bit nerdy. That's why I got into. I was a banker. I studied law. I worked in fields where you spent a lot of time thinking about what could go wrong. I mean, my wife finds me a bit nerdy that way, but boy, it
might be your German heritage.
But maybe. But it comes. It's valuable in investing. Avoiding the huge mistakes is going to help you better in the long term, I think, than trying to hit the big win here and there. And that's why, most Nobel Prizes have been won by people explaining that, everybody can't beat the average. If more people than 50%, or the median, for you statisticians out there, I want to get it right. But, if everybody beat the average, it wouldn't be the average. And that's why an index fund, if you have the patience to just stick with an index fund through thick and thin, an equity index fund, you'll do fine. My income factory is basically an alternative to that. And the kind of asset classes we tend to use would be funds that buy senior loans, high yield bonds, even preferred stock as a form of credit more than equity. And what you're betting on is that you're going to get back that close to 100% of those companies, those issuers, are going to pay back their debt on time. That's what you're betting on, that companies are going to pay their debt on time. And we know that if you've got a portfolio, if you invest in a portfolio of loans through, say, a closed-end fund, there are a lot of senior loan funds, and they're paying you a distribution of 9-10%, let's say, that reflects their portfolio, what it's doing, inside the fund. And in a default, let's start with normal times. In normal economies, you're going to have default rates of maybe 1%, 2%, and then in a recession, a garden variety recession of the sort, the hard landing they were predicting a couple of years ago that we still may not get, or might, who knows what post-tariff is going to, with the tariffs and everything. We don't know what the total impact is going to be, but even in a sort of ordinary downturn recession, might go up to 4, 5%, 6% defaults. And then in a really bad recession, like the so-called Great Recession of 2008 or so, maybe it goes up to 11%, 12%. What people don't realize, they see these default headlines, and they get really scared about high yield, this and that. Loans are well secured, and over time, typically they repay 60, 65%. So your loss, if you have defaults on corporate loans, is about, let's say, 35 to even 40% of your default rate. You have a 40% loss on 5% of your portfolio. That's 2%, 40% of 5%, be a 2% loss on your portfolio. You're collecting, say, 9, 10, 11% in interest on it. So the total loss comes out of the reduction in your interest for that year. So maybe you have only 6, 7% or 8%. That's a lot different than what would be happening in the equity market with that same garden variety recession taking place. Now you have a really bad one of, like we had 18 years ago or whenever. And that was, we had like 11, 12% defaults. But again, and on a high yield bond, you'd lose a little more. So you might have 50 to 60% losses on high yield bonds because they're unsecured, 30 to 40% losses on senior loans because they're secured. Put it all together, maybe you lose 50% of your high yield portfolio. So even 50% of that 12% in a horrible, horrible recession, the worst since the 1930s, and you're still only losing, 6% of your portfolio, but you're making, again, 9, 10, 11% per year in interest. So you take out your loss from your interest component, you're not even touching capital. That is such a different sort of expectation than you'd have going into any of those scenarios in an equity portfolio. So it doesn't mean there isn't some stress, but people get so excited negatively, many of them, and including many writers and media types, about high yield, how dangerous and risky high yield credit is. But what many of them don't realize, people who swear, I'd never buy a high yield fund, a high yield bond fund, or high yield loans. Those same people, if they look in their portfolios, probably have an allocation to mid cap and small cap stocks. And yet, if you look, almost all small cap stocks would be non-investment grade, i.e. they'd be junk, so-called. Most mid-cap stocks, very few mid-cap stocks would be investment grade. So anyone who's got those stocks in their portfolio, which most investors do, already is investing in the equity of these companies whose debt they say they'd never buy. And of course, if the company doesn't pay off its debt, it goes bust and its equity is worthless. So it took me a while to kind of get this idea across to my own readers and as my Inside the Income Factory, which is my investor group within Seeking Alpha. Now they all understand it, and the idea has gotten out there more and more that credit is, it's a very predictable sort of asset. Yes, with high yield credit, you do have defaults to kind of concern yourself with. If you buy there's very high quality credit, like government bonds and investment grade debt, but it only pays you maybe 2, 3, 4, 5% at the most. And if you're looking to make an equity return of 9 or 10%, it's better to invest in real credit risk where you get paid for it by buying high yield credit than to take all the interest rate risk that you take with long-term low yield bonds that don't pay you. You don't take much credit risk, you don't get paid for any, but you don't get paid much at all for the interest rate. Like what's 30-year credit I saw the other day, government bonds is like in the 4 to 5% range, and 10 years is probably around 4. I wouldn't lend my money to anyone, even if I knew I were going to get it back for 4% for 10 years or more, So you can get actual payment for taking real risk with credit. But I tell people it's like going to a racetrack and being able to bet on horses to just finish the race, just be in the field, get around, not die on the track and get back and finish the race. That's what betting on credit is. Betting on stocks is like betting on your horses to do better than average. So, to win or place or show. It's a very different bet. And if I can get paid almost as much to just bet on the horses to make it around the track, to me, that's a pretty good bet.
Yeah, absolutely. You invest not to lose, right? Like there are two different strategies. Like when you're gambling as well, you either play to win or you play not to lose. And of course, two different strategies, right? You're more into stocks. I'm guessing you're more into play to win. But if you're following the income factory strategy, it's more you play not to lose, but still achieve.
And look at the whole banking industry. J.P. Morgan, they've been making money. Citibank, they've been making money for generations, essentially doing that, within a corporate structure. And as I said, pension funds and insurance companies, they've been doing this for all of our lives, and just cranking out the money.
But Stephen, maybe to simplify a little bit, because we're using a lot of big words here. Like it sounds a bit scary, quite honestly. Like talking high yield credit, and we all seen the Wolf of Wall Street and all those different type of movies about bubbles popping and all of that. Like, how do we simplify it? Everybody knows how to invest a stock. You open your Robinhood, your app, and just buy your stocks. But buying high yield credit, like, does everybody have access to it? And how simple is it to replicate it? Like, how do we take that fear out of it?
Yeah. Well, first of all, I only buy funds, and because I'm not a major institution, you cannot buy corporate loans or high yield bonds for the most part, unless you're investing a lot of money, which is why these are mostly institutional investing asset classes that have been brought to the retail market through funds. So there are high yield funds that, high yield bond funds have been around for a long time. The major players, Fidelity and others have them. But there's also the closed-end fund market, which many investors are not as familiar with, but those who are tend to really like it. I use it all the time. Closed-end funds, of course, unlike ordinary open-end mutual funds, you buy the fund in the market, just like a stock, and then you sell it when you want to get out of it in the market, again, like a stock. So it's like think of a fund as an investing company. So with closed-end funds, you're investing in, and there are hundreds and hundreds of them, and you're investing in a fund whose net asset value, the value of any fund is its total value divided by, if you liquidated it and sold all the assets in it, that would be its net asset value. The net asset value of a closed-end fund can vary from its market value because you're buying and selling shares of it on the open market. So you can actually, by paying attention, being careful, you can buy into a lot of closed-end funds that are in the senior loan category, the high yield bond category, preferred stocks, those are, as well as utilities and other high yielding stocks. But you can buy them when they're at discounts, where you'd actually have more assets working for you than you had to pay for. So you might buy a fund whose return, its yield on its net asset value, it's the natural yield of the assets in the fund might only be 9.5% or 10%, but because you're buying that fund, you wait, you're patient enough and buy it when it's at a discount, you're getting a higher yield on those assets because you paid less for them than their actual natural yield. And that has a lot of advantages too, because usually the higher the yield, the greater the risk. So if you can buy assets whose natural yield is a little bit lower, but you're getting a higher yield on your investment because you paid less than 100% of their book value, their net asset value. That extra 0.5% or whatever you get, again, over a 20, 30-year investment program really makes a difference. So that's where I tend to look into the closed-end fund market. And so I'm only buying these assets in highly diversified funds. I'll buy a fund that buys senior loans or high yield bonds or whatever. And then I'll buy several funds because I like the diversification, not only of the underlying company, the issuers, but I like to have different managers. When I think of myself as a portfolio manager, so not so much an analyst. So I'm looking at these, I'm making a choice about which managers I really like, that have long histories and which asset classes I really like. And if I find a manager who seems really solid with a good record and an asset class that seems really solid, And I don't worry so much about the ups and downs. If I'm going to own it for the long term, I don't mind if it goes up. I never mind if something goes up, but if these things go down because markets are a little crazy, you reinvest, and you're actually reinvesting at a bargain price, so you're growing your income faster when you're if your assets are down, and it'll wash out in the long run.
What should be the investment horizon to follow your strategy? You've touched on 20, 30 years. Like, A, when do I start? And B, how long should I be following that strategy, Stephen?
Well, I'd say anyone who, when they get to be my age, wants to be retired, ought to start as soon as they can, saving money and taking advantage if their employer offers 401ks or anything like that. Get money out there and invest it. And frankly, there's nothing wrong with just say in a 401k or an IRA or whatever you have, putting it into index funds or large cap funds, of which, Schwab and Fidelity and there's so many around, where you can just put your money into a large cap fund and then try to forget about it, which is easier to do if you're working and you don't need that money to live on yet. It's best to invest it in solid funds, and then kind of, if you can, I don't mean you never look at it, but forget about it to a certain extent. Rip Van Winkle would have made a great investor in that sense. The income factory is an alternative to that for people who do want to look at it regularly and will get a little upset during the downswings. That's when, if you're managing your own money and you have access to income factory type choices, that's when, an income factory where you're making most of your return and compounding it, creating your own growth, I call it, by compounding. That's where that kind of my sort of a strategy makes sense. And it makes sense if you're prepared to do that, and that fits your psychological, makes it emotionally easier to be patient and sort of sit there and watch the grass grow in terms of your investment philosophy. Then an income factory makes sense at any age. It used to be I used to hear this all the time. Well, if you're 35 years old and need growth for the next 30 years, you have to invest in growth stocks. And I would say again, well, yeah, but if you can make that same 9 or 10%, if you think you're such a great investor that you can do better than average, then go for it, But most people can't. As I said, it wouldn't be the average if everybody could beat it. So
absolutely,
so if you're going to be content, and I think you ought to be, with making 8, 9, 10% continually for 30, 40 years, and letting it double and redouble, every 8, 9 years, whatever, then an income factory is just as good an alternative as a growth portfolio. The key is whichever one you choose to stick with it. Once you get to retirement, actually an income factory, if you've got your capital that's creating an income that you're reinvesting, say for 30 years or whatever, and compounding, once you get to whatever, 60, 65, 70, where you need to start taking some of it and living on it. Now that's when having an investment philosophy where you're never touching your capital, you're just letting it, because you're getting 8, 9, 10% cash income from it all the time. At a certain point where you need to take some of that cash income, and instead of reinvesting it for additional growth, you now need to start living on it. Income factories avoid a common thing called sequencing risk, which you have if you've got an equity portfolio yielding 1 to 2% and counting on growth, and you have to take some of it out every year because now you've gotten old and you start to need to take out some retirement. You need to create your own pension with it, so to speak. You have the risk that in a down year, you still have to take money out, which means you're now invading your seed capital. If you have to sell in a down year, if you're retired, because you need that 5% or 6% or whatever you're taking out. Now, if if you're not retired yet, you don't care about a down year in stocks because you're just going to hang in there and it's going to come back up. But you don't want to have to start liquidating capital during down years, because then you're permanently invading the money you're counting on to create your future income. So once you're into the retirement part of your life, then an income factory is probably a real advantage because of that sequencing risk.
No, absolutely. Like, Steve, maybe let's get a bit to the here and now, or let's discuss the last 6 months and so all the macro shocks that we've seen. Like, how have they impacted your strategy, and how should investors that have been duplicating your portfolio strategy or your income factory strategy adapt to those like frequent changes and the uncertainty that you're seeing in the market?
Yeah, it's there is a lot of uncertainty. I think what's the disconnect you sometimes find in the market, and something you have to be aware of if you're an income investor, is that, you know, when you have uncertainty, and without getting into the politics of it, I think we'd all agree there's plenty of uncertainty right now here in the U.S. especially, and you know, we don't know what the impact of tariffs is ultimately going to be in terms of how, you know, whether it's going to drive up prices and inflation, and whether this move to lower interest rates could be a short-term thing if in fact inflation starts to you know, come back stronger in the next few months. We don't know about that. We don't know whether the impact of tariffs and some of the other things that unfortunately they've done about cutting, you know, the planned cuts in Medicaid and other social services and education, these are going to impact mostly our, you know, lower income part of our country. But, you know, I mean, we're all in this together, and it could be very, I don't know if it's going to cause a downturn or recession or what. On the other hand, the market seems very confident. The stock market seems very confident. And there seems to be a feeling, I guess, among the investor class in America that whatever is going to impact the overall economy will not impact the more affluent part of our economy, which is the one that owns stocks and other investments. So it's hard to figure out how that's all going to happen. But what I believe, and what strengthens my commitment to actually credit markets, if you have to be in the investment, I'm not going to come out, I'm not going to go to the sidelines to wait for this to happen, because that's how you know, I need the income. So if I'm choosing between credit and equity right now, I think the choice becomes even more of a credit choice being the right one, because I think one thing we've learned through the great crash of back in, you know, 18 years ago and the COVID situation is that, and I've written books actually about CEO pay and some of the challenges of the way we compensate our senior most corporate people. They sit on each other's boards, set each other's pay. It's not the way capitalism is really supposed to work. But what it does do is the people who run corporate America and corporate world, if you will, have enormous skin in the game. And they are going to do everything they possibly can, even if their stock tanks, if the economy tanks. I think we've seen that the people who run our companies have so much at stake that they will find a way to muddle through, keep their corporations alive, even if their stock tanks, even if the economy tanks. The people that run it will keep it going, and that means they're going to pay their debts. They're not going to let their companies go bust, even if their stock does, you know, really go into the hopper or wherever it goes. But that's why, for me, I think credit really is for me, it's the way to go to kind of get through whatever lies ahead. Now, if I'm wrong, and if the stock market really, you know, shoots up, although a lot of people think it's been kind of valued anyway. So if I can get my nice 9-10% return surviving the next year or two or whatever, however long this takes, and the global economy is being so shaken up. I mean, we're sending such negative messages to our countries that have been our friends for my entire lifetime. I mean, it's so sad to see, and I don't know what the impact of that's going to be longer term. So anyway, credit, where you're just betting on those corporate horses to make it around the track and make it to the finish line, seems like a better bet than ever in this current environment.
No, fantastic, Steve, that's the perfect way to end the conversation here. It's already 30 minutes we've been chatting. It's been absolutely phenomenal. Really interesting to learn about your income factory here and how we can sort of duplicate your strategy in general. Where can we send our audience to follow more of your work? And we'll get you back by the end of the year, by the way, to set up for 2026.
Well, if any of them are readers, if they go on the worldwide website Seeking Alpha and just Google, if they Google my name or Google the Income Factory, either just Googling it generally or going on Seeking Alpha, they'll find their way to a number. They'll have a number of links that'll get them to my service.
Sounds good. Fantastic. Stephen, really appreciate you joining us.
Oh, sure. Thank you.
It was really insightful. We'll have to catch up later this year, see how policies have changed and how your income strategy is working out in terms of yield and what it is yielding and what your performance was in 2025. We'll see how far the S&P will run from here. As you said, we're on shaky ground. So we'll see where it goes.
Well, it's an adventure. I tell all my readers I'm on a steep learning curve with all of them.
Absolutely.
So
no, Stephen, thank you very much. Really appreciate it, and everybody else. Thanks so much for tuning into Soar Financially. Really informational, really educational what we just discussed here with Steve Bavaria, and really looking forward to getting him back on at the end of the year to see how his strategy worked for 2025. And of course, we need to talk about his performance overall. So really curious. And if you haven't done so, hit that like and subscribe button. Helps us out tremendously, and it's free. Thank you so much for tuning in. We'll be back with lots more. Take care out there.